Welcome back to the deep dive. Okay, we've got quite the stack of data this week. The full Q2 FY26 unaudited results for Canara Bank, plus segment reports, the earnings call transcript. It's a lot.
It is. And with a bank this size, just looking at the headlines doesn't really cut it, does it?
No, you have to dig deeper. Find the strategic thinking behind the numbers.
Exactly. So our mission today is basically to boil all this down, figure out where Canara Bank is winning, where they're facing, headwinds, and what management's game plan looks like.
And we're focusing on the quarter and the half year that ended September 30th, 2025.
Right. We'll be keeping an eye on a few key things. Profit growth, obviously, asset quality always crucial, and then those strategic ratios like SASA and NI.
Net interest margin. Got it. Let's jump straight in then. Okay, let's unpack the big picture first, looking year over year, September 25 versus 24. The sheer scale of the growth is, well, it's pretty impressive.
Global business grew by, 13.55%?
Yeah, crossing 26.78 lakh crore. Huge number.
And global advances, the loans, basically also surged, up 13.74% to 11.51 lakh crore.
That's the engine for future income right there.
It absolutely is. But growth alone isn't enough. You need profits to follow. And the good news? Well, they seem to be keeping pace. Operating profit hit an all-time high.
Really? What was the number?
8,588 crore. That's up 12.20% year on year.
Okay, so profit keeping pace with that big balance sheet expansion, that's often tricky.
It is. And the net profit, the bottom line, actually did even better. Jumped 18.93%.
Wow. Landing at
4,774 crore. That kind of growth, it translates directly into shareholder value.
Makes sense. And the earnings per share, EPS, reflects that strength too.
It does. Stood at 21.01, which is like a 20.68% growth year on year. Really strong.
So when a bank's growing its total business this fast, maybe 14%, I always wonder about efficiency. Are they growing smart?
Good question. And that's where return on assets, ROA, comes in. It actually improved.
Oh, interesting. By how much?
By 7 basis points. It's now at 1.12%.
Okay, 7 basis points might sound small, but on assets that large.
Exactly. Improving your ROA while your total assets are ballooning by 14%. That tells you something about operational efficiency. They're squeezing more profit out of every rupee of assets compared to last year. It's a key sign.
All right, so the bank's big, profitable, growing fast. But where's that momentum coming from specifically? The data seems pretty clear on this one.
Oh, yeah. It's all about the RAM sector. Retail, agriculture, and MSME credit. That's where the action is.
It's absolutely flying, isn't it?
It really is the main growth engine right now. Expanded at 16.94%. That brings the total RAM loan book to 6.71 lakh crore.
And the growth isn't just uniform across RAM, is it? There are specific areas pushing harder.
Definitely. The breakdown is, well, quite revealing.
What stands out the most?
For me, it's the retail credit segment. It didn't just grow, it exploded. Up 29.11%.
29% in 1 year.
Yep, reaching 2.51 lakh crore. That's almost a third bigger in just 12 months.
Wow. What's driving that within retail?
Housing. Housing loans showed strong growth, sure, up about 15.25%.
Yeah.
But the real standout was vehicle loans.
Okay.
A staggering 25.58% growth there. That points to some pretty robust consumer demand that the bank is capturing effectively.
But when you see growth that aggressive in retail, nearly 30%, does it make you wonder about, I don't know, future asset quality? Are they chasing volume too hard?
That's always the balancing act, isn't it?
Yeah.
And management seems aware. They also highlighted the MSME credit growth, 12.70%, hitting 1.54 lakh crore.
Right.
And they specifically mentioned this is the first time in like 5 or 6 years that the MSME book has grown above 12%.
So that suggests maybe the broader economic recovery for smaller businesses is finally kicking in.
Seems like it. And it's feeding directly into the bank's lending now.
And this big shift towards RAM, towards these smaller loans, it's deliberate, right? A strategic choice.
Absolutely. They're actively trying to change the mix of their loan book. Management explicitly stated the goal, 60% RAM, 40% corporate.
And they want to get there when?
Within the next 1 to 1.5 years, roughly.
Mm-hmm.
So they're deliberately keeping corporate credit growth lower, around 10–11%.
Even though they could lend more to big companies, I think I saw a note they cleared something like 26,000 crore in corporate loans in just one meeting.
Exactly. They have the capacity. They could easily push that corporate number higher.
But they're choosing not to.
Right. It's a strategic choice.
Yeah.
They're going for the better margins in the RAM segment, even if it means more work, more operating cost. They believe it protects the bottom line better than just chasing corporate volume.
Okay, so we have this powerful growth story driven by RAM, But there's always friction, right? What are the big challenges, the headwinds?
Yep, that brings us to the core balance sheet issues. Net interest margin NIM and the K-SAR ratio. Let's tackle NIM first.
The margin squeeze, it's affecting everyone.
It really is, and Canara Bank is definitely feeling it. Their NIM is currently at 2.50%.
2.50, and where was it, say, a year and a half ago?
It was around 2.9% just 6 quarters back, so that's a pretty significant compression.
And just for context, for a big public sector bank like this, getting below 3% is, well, it puts pressure on profitability unless they find huge efficiencies somewhere else.
Absolutely, it's a structural concern.
What's the main driver behind this drop?
It really comes down to how quickly interest rate changes flow through their books. You've got almost half, like 46% of their entire loan portfolio linked to the RBI's repo rate.
Okay, so when the RBI cuts rates or even holds them steady after hikes, those borrowers feel the benefit almost immediately.
Instantly. But the bank's own cost of funds, that's a different story.
Doesn't adjust nearly as fast.
Nowhere near. Because something like 90% of their deposits are term deposits, fixed rates. So the cost of those deposits takes, 9 to 12 months to reprice downwards as the old, higher rate ones mature.
And that lag between the loan rates dropping and the deposit costs dropping, that's what crushes the M.
That's the squeeze, right down to 2.50%. Management thinks it might stabilize here for maybe one more quarter.
And then maybe tick up.
Hopefully an uptick in Q4, but that's if the RBI doesn't cut rates again, and if those older, pricier deposits roll off as expected.
Okay, that's the NIM picture. What about the other headache? SESA, low-cost current and savings accounts.
Yeah, the SANSA ratio is currently sitting at 30.69%. Their own guidance was, I think, 32%.
So slightly short of target. But the challenge isn't just getting the percentage up, is it? It's more complicated.
It is. It's what you might call the moving target problem. On one hand, they're actually doing pretty well in growing absolute CASA numbers. Over 10% year-on-year growth.
That is good, right?
That's the first time they've hit that in a long while.
Right.
And they pointed out a record incremental growth, 120,000 crore in individual savings bank deposits over the year. Haven't seen that in maybe 7 or 8 years.
Okay, so the CASA engine is working harder.
It is, but here's the catch. The total balance sheet, the denominator in that ratio, is growing even faster. Remember that 14% overall growth?
Ah, right. So they're paddling furiously, just sort of tread water on the ratio?
Yeah, that's a good way to put it. They have to run faster than ever just to try and keep that ratio close to 30%, let alone push it up significantly towards 32%, given how fast the overall bank is expanding.
So what are they doing? What are the specific initiatives?
They're getting really granular. They're rolling out new products, specifically targeting segments they might have overlooked before.
Like who?
Farmers, for one, and also the gig economy workers, that whole growing segment, trying to design savings products for them.
Interesting. And on the current account side?
Boosting digital. They mentioned allowing current accounts to be opened using tablets now. And also new products aimed at institutions, think NGOs, societies, even pilgrim centers, trying to capture those potentially stable, low-cost institutional funds.
So searching every nook and cranny for cheap deposits to try and nudge that CASA ratio up.
Pretty much.
But
They need it to eventually help that NIM situation too.
let's shift gears a bit. Let's talk about the quality of those assets they're putting on the books so quickly. This seems to be a real area of strength.
Oh, absolutely. The improvement here is quite dramatic, actually. You see it across the board.
Give us the numbers. Gross NPAs.
Gross NPA ratio improved significantly. It's down to 2.35%. That's a fall of 138 basis points year on year. Huge improvement.
And net NPAs after provision.
Even better, down to just 0.54%. That's a 45 basis point drop.
Hold on. 0.54% net NPA. For a bank this size, especially a public sector one, that's incredibly low.
It is exceptionally good.
But it raises that question again with 14% balance sheet growth. Is that sustainable? Are they just delaying the problem, or is the quality genuinely that good?
Well, the other metrics suggest it might be genuine. Look at their provision coverage ratio, PCR.
Okay.
It improved further. Now stands at 93.59%. That's a very thick cushion.
Meaning they've set aside a lot against potential losses.
A huge amount. And their credit cost is down, too, to just 0.68%. So the numbers suggest they aren't just recovering old bad loans. They're actively building strong buffers against future problems, even while growing fast.
Speaking of future problems, management spent some time talking about being ready for the new expected credit loss ECL guidelines. Those kick in March 2027, right?
Correct. And this is where their prudence really showed. They seem very confident the final impact will be minimal
Why? What makes them so sure?
because they're effectively already doing a lot of it. They're already provisioning against standard assets where they see even a hint of stress. Management said, look, we have about 7,500 crore in SMA special mention accounts above the 5 crore threshold.
Okay, so loans showing early warning signs.
Right. And out of that 7,500 crore, they've already proactively provided 5,000 crore.
Wow. So they basically front-loaded a huge chunk of potential ECL requirements already.
Exactly. They're getting way ahead of the game.
Right.
But there was one specific example they gave that really caught my eye.
Oh, yeah. What was that?
They made an additional precautionary provision of 380 crore for a single asset, an asset that was still classified as standard, not NPA.
Why would they do that for a standard loan?
It was a Telangana drinking water project. And the reason? It kept popping up in the SMA-1 or SMA-2 categories, meaning payments were slightly delayed, 30 or 60 days, but not yet NPA.
So even though it wasn't technically bad, the warning light was flickering intermittently.
And they decided, nope, let's just provision for it now, be extra safe, even though the rules didn't strictly require it yet for a standard asset.
That sounds like, well, proactive risk management in action. Almost conservative paranoia in a good way.
That's exactly what it is. They're saying, we see a potential issue down the road, let's address it now. It really signals their approach to risk well ahead of that 2027 deadline.
Okay, moving on. There are also some interesting strategic plays happening, some big one-off gains coming up soon.
Yes, this is about unlocking value from their other businesses, their subsidiaries. This is going to make Q3, the current quarter, look very interesting financially.
What's the main item?
They're expecting a net benefit after expenses of about 1,935 crore.
From where?
From selling down stakes related to the IPOs of two subsidiaries, Canara Robeco, their asset management company, and Canara HSBC Life Insurance.
And that entire 1,935 crore hits the books in Q3.
Correct. It'll be booked as an exceptional gain. That's a pretty hefty boost to the quarterly profit.
Definitely. And wasn't there another benefit they booked in Q2 already from something called PSLCs?
Ah, yes. Priority Sector Lending Certificates. They generated about 900 crore in benefit just from selling those in Q2.
Okay.
And what's really interesting is they mentioned they're still sitting on a stockpile, about 25,000 crore worth of these PSL certificates.
Which they can sell whenever they need to.
Exactly. They can sell them strategically depending on market demand and their own needs. It gives them quite a bit of flexibility on the fee income and regulatory side, like having extra chips they can cash in.
Right, significant balance sheet flexibility there. Okay, what about diversification into new business areas? Gold loans came up.
They did. Management made a pretty bold claim, being the #1 gold loan banker in India.
#1, wow. How big is that portfolio?
It's crossed 2.11 lakh crore. Apparently, it's quite profitable for them, yielding around 8.75% to 8.8%.
And safe. Gold loans are usually seen as pretty secure.
Very low risk, according to them. Slippage loans going bad is less than 1.1%, but they did caution it's not easy money. You need the right infrastructure and professionalism to handle that volume.
Makes sense. Anything else on the diversification front?
They mentioned actively building up their capabilities in M&A financing, moving into slightly more complex, higher value advisory and lending.
Okay.
And they also successfully launched an online loan against mutual funds product. They noted they're only the second public sector bank to offer that digitally.
So definitely pushing into new fee-generating areas, especially around capital markets and investments.
Seems to be the strategy. Broaden the income streams beyond just traditional lending. #tag outro.
This has been, well, a really detailed look. A bank growing incredibly fast, but also wrestling with those margin pressures and the CSA challenge while showing real strength in asset quality.
Yeah, if you tie it all together, you see this clear strategy. Push hard on RAM credit for growth. Manage the corporate book more cautiously, clean up assets dramatically. That part's working.
But the long game.
The long game, the real test for future profitability, is that relentless focus on finding new ways to get low-cost funds. Targeting farmers, gig workers, using digital tools for current accounts, everything we discussed. That's absolutely critical to eventually ease that NIM pressure. Tackling the Case A challenge is the key play.
So here's a final thought for you, the listener, to maybe chew on. We see this massive growth ambition, right? But it's clearly paired with a very deliberate, almost cautious, forward-looking risk strategy.
Right, they're not just waiting for regulations like ECL to hit them.
Exactly. They're pre-provisioning, like that specific 380 crore on the Telangana project, even when not strictly required. And they're unlocking value from subsidiaries before they perhaps have to. So you have to ask yourself, how much sort of hidden comfort or resilience do these proactive voluntary steps actually build into the bank? And how different is that approach from institutions that might just wait until the regulatory deadline forces their hand?
It really encourages you to look beyond just the top-line growth numbers.
It does. It makes you think about that balance between driving expansion and meticulously managing the risks that come with it, something to consider as you watch their performance unfold.